Welcome to the show. My guest tonight, Mitch. Can you tell me a little bit about yourself?
Yeah, for sure. My name is Mitch Paglinawan. I'm a business owner, and I help families with their financial needs. So whether it's saving money, paying less tax, getting out of debt, I teach them about that stuff. Okay, and then hopefully they have now the tools to put themselves in a better financial place, and I'll help them do that if they want to do that. So that's kind of like my professional background, but I guess that's what I'm currently doing. My original background is I used to be an engineer.
What kind of engineer?
Mechanical.
Okay.
So here in Calgary, the University of Calgary did that whole deal. I actually got a double major in astrophysics, but
Wow.
we don't really talk about that too much because there's not much to talk about other than as an accomplishment. But,
Yeah.
I did the whole
Is
the
that
whole
still
thing here.
an interest of yours?
It's cool,
Yeah.
but I'm already out of date so much
Mm-hmm.
that people that maybe they'll read something online of like a discovery that would happen 2 years ago. Oh, did you hear about this?
Yeah.
I have no idea what you're talking about. So
It's probably changing so quickly
yeah.
with all the technology that we have.
Yeah, I would just think like the new telescope came out after I graduated too. And that opened up a whole new world for people discovering stuff.
So is it still a hobby of yours? Do you even have time?
No.
Yeah.
No. It's an interest, and I have a little bit of like education to sort of back up my interest. But yeah, I don't really have a whole lot of time to dive into it anymore. So, but it's cool.
So, and mechanical engineering.
Yeah.
Why didn't you go that route with your life?
Well, in Alberta, you kind of get, from what I saw at least, by the time I graduated, you kind of get put in this box of, well, if you're going to be an engineer, you either stay here in Alberta or you get out. And the percentage of people that get out is pretty small, like, because the industry in Alberta is attractive for a lot of people. Like, they get to work in the energy industry, oil and gas, can make relatively good money to maybe your peers, but you do have to sacrifice a sort of bit of your life, right? Because you're doing shift work. Tough, I would say. I mean, people have their different opinions about it, but I would say it's kind of tough to start a life. You can have a good career, but I think it's kind of hard to start a life when you're doing that kind of shift work. And then when I was working in the industry, you have to do this thing like interview your future. So was I 26 at the time? Talked to somebody who was 46, 50 years old in the exact same like career path that you would have went on. And I recommend everybody do this, no matter what kind of career you're in. If you don't like that, what that guy's going through, divorced, right?
Mm-hmm.
Deranged from the family, makes good money, but like at what cost? If you don't like that, then get out.
Yeah, that's really good advice. I bet a lot of people don't ever even think to do that.
I think a lot of people get caught in this, oh, it'll be different for me.
Mm-hmm.
I'm different. It'll be different.
So how long were you in that industry?
I tried to stay in it I would say I was in it for like a year after I graduated before I decided I didn't want to do it.
Mm-hmm.
Got out, dabbled in like traditional business, right? I tried doing different manufacturing businesses, failed a lot, which is cool. But then wanted to have the benefits of business, but have something that was actually successful, right? And I didn't have to worry too much about it. Got out, wanted to find business, wanted to find something where I knew the industry was good, like it was with engineering.
Mm-hmm.
I mean, I wanted to go into engineering because the money was good. So what do you do? Like if you got the brains for it, you go and become an engineer, or you go become a doctor. That's kind of the traditional career path.
Lawyer.
Yeah. Same thing. Something with a professional designation attached to it. typically means good money. But yeah, I guess I ventured more towards the engineering side, which I was good at, but unless maybe if I lived in the States, it would have been different. But just I think being in Alberta might have twisted what my outcome expectations were going to be. If that makes sense.
So did you meet someone who recommended it to you, or did you do research and go with this new career path on your own?
I met somebody actually. You might actually know them.
Maybe. I know a lot of people.
Mike Fox?
I don't think so.
He was a bartender at
Maybe if I saw a face. We'll bring it up after.
yeah. You know, I ran into a guy that I used to bartend with, and it was on those Tuesdays when we were cleaning the bar, because I knew you were Stampede season mainly, but Tuesdays we'd clean the bar, we'd go to Zen 8 and get some food at lunchtime, and I see an old bartender just wearing a 3-piece suit.
Yeah.
I was like, okay, what are you doing? Like, what are you up to? Like, why are you dressed so nice? Got to chat with him a little bit, and he said he was doing this thing, you know, he was wanting to just kind of fill me in. And I'm like, okay, like, let's hear more about this. We sat down for a coffee. He taught me a bunch of stuff that just like, I should have been doing this years and years ago.
But have you seen Wolf of Wall Street?
Yes.
Was it like that scene where he's like, write down a number, how much you make, and I'll quit my job right now? That's what I'm picturing.
Kind of. It was, it was more of, I guess I wasn't so like money motivated at the time. I mean, I was a newly graduated student, I think. I'm trying to remember the time frame there. But I was looking for something that was like going to be useful for people, for myself too, right? For my family, for my peers, but something that was going to be useful long term. And when he showed me, I was interested. But I think the first time he showed me, I was actually still in university, now that I'm thinking about it. And the worst thing you can do is try and get somebody to quit an industry that they haven't even officially started yet.
Yeah. What was it that he showed you? Was it the same thing you're doing now?
Yeah.
And what was it? What is that?
So he showed me, one, a little bit about the company, just kind of like what he does for families. Like, you know, this is all the money that comes in to a household on a monthly basis. Half goes to taxes, 25% goes to taxes, 50% goes towards your basic living expenses, right? And then the other 25% goes towards debt. Like, what part of that pie do you see where people are saving money? And he's like, well, there's this little sliver in here in between the 25 and 25, and we call that savings. And the average family is saving 2% of their income. It's like, okay, go on. And, you know, well, what we do here is we'll teach you how to free up some money on the tax side, free up some money on the debt. I mean, if you overspending on, you know, 20 Netflix subscriptions, maybe we'll fix that too. But we'll free up some money, help you save, and we'll put it into things that matter, like retirement savings, pay off some debt, save for your kids, right? Education.
So is it like financial planning, or is it different than that?
It's like financial planning. I can't say financial planning because it's a registered like title.
Yeah.
But yeah, we're financial professionals that are just going to be able to educate you to give you the tools that it's going to take for you to help yourself, even if we're not the ones that help you, right? We can provide a lot of the products and services that they would probably want. But if they decide, no, not for us, at least we can give them the education. We can arm them. Right.
And how long have you been doing that now?
Almost a better part of a decade now. I would say 8 years. I mean, I think I might be in my 8th.
So what are the biggest differences from when you started to now that you've seen when people come in?
Well, I was foolish to think that things would get better over time. Because in that first time that I sat down with him, he was like, you know, 91% of people, 9 out of 10 people are not going to walk into retirement successfully. He's like, you look around and, you know, the 10 people, including yourself, that you know and love the most, none of them aren't going to make it.
Yeah.
They're relying on the government. The dream they had of the lifestyle that they wanted in retirement, that's not going to happen. And okay, 10 years ago, do you think things have gotten better or worse since then, financially for people?
Well, things are pretty tight right now.
I,
So,
I think a lot of people are feeling the same way.
yeah.
If they were saving, if they were squeaking in $500 a month in savings, which is pretty good, they're probably not doing that now.
Yeah.
Maybe a couple hundred. And their lifestyle changes too, right? So.
Yeah, it's hard to say because I bet people have started making a lot more from when they first started planning. So they might think they're saving more, but it's maybe a lower percentage.
Well, we'll put it this way, because there's this, I guess, penalty in waiting too. We were chatting about this before, but like, let's say you wanted to retire and you're going to start saving at the age of 20 and you wanted to get $1 million. How much money do you think you'd have to save per month, every single month, getting like a 9% rate of return, right? So like, it's like index fund rate of returns.
I have no idea. I would say I have no idea. What is it?
It's about like $160 a month
Really?
consistently.
That's manageable.
That is manageable.
Yeah.
What if you didn't start at 20?
Yeah. Like nobody does, really.
What if you started at 30? How much do you think you'd have to save?
Like 500?
Close. Like it's high threes.
Okay.
Like 370. 370. My math's right. What if you waited till 40? You wanted $1 million at 65.
Yeah, then 700.
About $1,000 a month.
Okay. Yeah.
Right. So what's more manageable? $160 at 20 or 980 or whatever the number is at 40? Yeah, you could be making more money.
Yeah.
Are you making 3 times as much though?
Probably not. Yeah.
And do you have kids when you're 20? Do you have a car payment, a mortgage payment?
Yeah.
So when that 9 out of 10, it's like, yeah, right. And then you start to get a little older and you're like, oh yeah, no, that's pretty accurate.
Yeah. So that actually makes me think of, I was going to ask you about at different stages in your life. Like, let's say you're talking to a teenager or someone with kids in that range, what they should do at that age, and then maybe 25, 35, that kind of thing.
Okay.
What would be the first absolute thing you'd recommend? Can we say recommend?
Yeah.
It's not financial advice. I always see that on videos and podcasts.
We can recommend. We can probably, to some gray area realm, give advice. I won't give specifics.
Yeah.
To keep it safe. But the best time to start saving was when you're 18, right? Because that's when you can save on your own. The next best time to start saving is now. So like any day after today is going to be worse than today if you're just starting saving. So if you're 18 and you can only save $25 a month because maybe you have a great job or you don't have that much disposable income, save $25 a month. That's cool, right? You're probably saving more than your buddies.
Yeah.
Right. And then people might get caught up on the number a lot. I think the biggest hole that people have is a habit of saving. Because going from 25 to 50, once you've been doing it for 2 years, is not hard. Going from 0 to 400, because you lack discipline or the knowledge to save consistently, that's harder than doubling something that you've been doing.
Yeah, I was trying to always do 10% immediately. It's not as easy to always do that. Maybe it'd be better to just pick a number, I guess.
If you pick a number, well, some people's their income does like fluctuate. So that could be difficult if you're just doing 10%. A number's good because at least the number is predictable and you can like track it, I guess, into the future. I was going to say one more thing. Oh, if you want to do your best to, if you're going to do it consistently, like take it out of your emotional hands. Okay. Like save first, pay your bills second. This is going to sound controversial, but like, if you like, let's say your rent is due on like the last day of the month, just make sure whatever you want to save, 25, 50 bucks, it goes into your savings account or your tax-free savings account or your investment account first. Because there's always going to be some like extra money that you have that you didn't, it's like your personal money.
Yeah.
You like, oh yeah, this is my fun money. If the tax-free savings or your investment is the last thing to go in, you're going to spend it. Almost guaranteed, especially when you're young.
Definitely.
So if you can make sure that gets out of your bank account first and into your savings.
All those years that I didn't pay tax on my tips, I really regret. Yeah. Yeah. Young people, for the most part, are not going to think about retirement because they're young.
Mm-hmm.
So how would you get them to even think about that?
That's a good question, because most kids aren't taught to think like that in the first place. You know, if you're take a look at some more wealthy families. Wealthy kids typically come from wealthy families. And it's not because of like generational wealth all the time. It's because mom and dad are teaching them like how to think.
Yeah.
Early on. They're teaching them like, you know, the amount of money you make is based off of the work that you do, not the time it takes you to do it. Right. So that's like the business mindset for them as well. But that, you know, that's a, like, how do you like reprogram kids that I might spend an hour with? You have to like show them examples. You have to show them like what is now and what could be. But like a dollar amount might not really click with them.
Yeah. I have a 15-year-old. I don't think he would. They don't even really know the value of money. If you don't have bills and people always taking your money and it's just there, maybe it's not as important. But like you were saying, if you start at 20, it's that much easier to become a millionaire, I guess.
Yeah, but being a millionaire to a 20-year-old doesn't mean much.
Also, $1 million in 45 years might not be as much.
Yeah.
So.
Yeah, no, inflation eats that away.
Yeah,
people have been
I
noticing
know
that.
a lot of people who have started saving or save, and they just keep it all in cash, which is crazy to me.
Yeah.
It's like,
if you keep your money in cash, it's like it's getting devalued every single year. You don't even know it because the number's the same.
Yeah.
But, you know, milk has gone up.
Yeah. So what would be like the first most basic place to put your money that's not cash?
For an 18-year-old or a kid?
For anyone, really. If someone hasn't saved anything and only has $5,000 in their checking account, just leaving there.
Yeah, well, I always say that somebody should have an emergency fund account. It's just something that they're comfortable with, that they can have access to money right away. So they don't have to wait for like investment companies, like transaction times. That looks different for everybody. I've got clients who 15 grand is like their safety shell.
Yeah.
Right. Other people, it's $1,000. But for the stuff that they don't need as emergency fund, if you're over 18, tax-free savings account is probably your best bet. That's when you first get access to it. And I think the number right now is you get $7,000 of contribution room if you're fresh 18. The percentage of kids that max that out is like 1.
Yeah.
Like from year 1. It's, yeah, because 18-year-olds don't typically have 7 Gs kicking around that they're disciplined not enough not to spend it. But if you're younger than that, there's a couple options first off, one, I'm wondering where you got the $5,000 from if you're like 16 years old.
Yeah.
If you have the ability to, you can get an investment account like through your parents, have them like it's in their name, but if they might not be using the contribution room, right? So you could use that. Right? Obviously, you got to run it through mom and dad. But there's other vehicles that you can have set up by the time you're 16. Like you can put in like permanent insurance policies on yourself. I believe it's 16 is the age, and you're essentially investing, right, while taking care of an insurable need at the same time, which is going to be really low, right, because you're a kid. But it gives you a tool to invest early. And that's assuming you're not going to be needing an RESP, right? You're not planning on that $5,000 to go towards university costs.
What about the difference between an RRSP and a TFSA?
What about the differences?
So I know some people only contribute to one or the other. What would be the use cases for either of them? Or both, I guess.
Okay. Well, I'll break down exactly what they do.
Mm-hmm.
So why do people like RSPs for starters? Like what's the...
I don't even use mine.
Okay.
So
the biggest factor for an RRSP is that you get a tax deduction.
Mm-hmm.
Okay. Reduces income off the top when you go to do your taxes. So to give you an example, if you made $100,000 this year, gross, right? You don't have a plan through your work, right? Let's just say that. And then you took $100,000 of your net income and put it into an RRSP. Okay. Now you get a $10,000 tax deduction off that amount, which means when you do your taxes, it would almost be equivalent to you now making only $90,000 a year, even though you made $100,000. So throughout the year, you've now overpaid on your taxes because you've been getting taxed like you've been making $100,000 a year.
Mm-hmm.
So what do? You get a refund. What do you do with that refund? A lot of people will spend it. Right? That's why a lot of the good car deals and Visions deals come out in like
Tax
March.
time? Yeah.
It's because they know people are getting a paycheck. So a lot of people spend it. A lot of people put it towards debt. But just keep in mind that the tax deduction you got, the money that you put into the RRSP, it's just tax deferred.
Yeah, when you pull it out, you have to pay that tax.
You pay that tax. So if you're saving tax now to pay later, you want to make sure the tax that you're saving on, the refund that you're getting, you're going to utilize that. So that extra refund that you got when you did your taxes should be invested, preferably in a tax-free or a tax-efficient vehicle. Or else you're just going to be essentially paying tax twice or not investing that amount.
So you get the refund. Would it be good to put it back into the RRSP or to put it into a TFSA?
If you could put it in a TFSA, put it into a TFSA. Yeah.
Okay. It's almost tax season, so people
should know this.
Yeah.
Okay, so that's RSPs, right? Like the cool thing is that I like it when work sets up an RSP for me.
Mm-hmm.
Like if you're an employee and you have an RRSP plan through your work, maybe they match it, right? You put in up to $200 a month. They put in $200 a month. If you put in $300, they put in $200, right? But if you put two, they put two, that's like 100% rate of return already. And I'm always good. I'm always happy when free money comes my way.
Yeah.
Okay. So that way, hey, you know what? It's going to lower your tax bracket, or not your bracket. It's going to lower the amount of income that you make according to the CRA. So your taxes will go down, right? And you have this taxable vehicle in retirement, which half the contributions weren't yours anyway. Cool. So that's great. But for those people that have only an RRSP, I'll put it into like a worst case scenario for you. Husband, wife, say they got 2 kids. They got $1 million. Husband has $1 million in his RRSP. Well, what happens? He passes away. In Canada, you have a one-time rollover to the spouse, tax-free. Okay, so if he passes away, wife gets $1 million RRSP. If she passes away, what happens? Well, the whole thing gets taxed like she earned it that year. So marginal tax rate in Alberta, 48%.
What if, sorry to sidetrack you, what if that person is not married? Who gets that? Like, can it go to another family member or?
No,
Oh, that's
not
too bad.
tax-free. Not tax-free. Now, depending, like you can set a beneficiary, but that's after it goes through the whole, the government process.
Yeah.
So when it gets taxed like they earned it that year. And if you made $1 million on the year that you passed away, you're going to get taxed like you made $1 million.
Yeah.
Plus what you actually made.
Mm-hmm.
So say about a half, give or take, right? The rest, if there's no beneficiary set, goes to your estate, pays those estate taxes, right? And then it goes to whoever's left. Typically, well, I wouldn't say pennies, but like fraction of the original amount.
Yeah.
So that's worst case scenario, right? Nobody uses it. It gets taxed at the highest bracket.
Such a waste. All that time. Yeah.
Yeah. Probably took a long time just to save up the amount that they get taxed, right? $500,000.
Yeah.
So it takes a long time to save that amount.
Mm-hmm.
No, a tax-free savings account, the same thing happens, right? The same scenario. Well, what do the kids get? They get $1 million.
Yeah.
It's tax-free, right? There's limits to a tax-free savings account, of course, just like an RRSP.
Yeah. My wife uses her RRSP. I always only use my TFSA because it's just always way shorter term. So
If you're a high income earner, it makes sense to use an RRSP.
I'm not. Maybe one day. Look at all this.
Yeah, this place is beautiful.
Yeah.
But like if you take a look, you can open this up on the Government of Canada website. Like you can take a look at your marginal tax rates.
Mm-hmm.
There's quite a bit of jumps in depending on how much money you make. Like I think the current numbers like just over 100,000, like 107,000. If you make $100,000, your marginal tax rate's 30.5%. I think. Don't quote me on this. I don't pay attention to this stuff too much.
Mm-hmm.
But let's say you make $110,000. Your marginal tax rate's 36%. So any dollar you make, you're getting taxed 5.5% more than if you were making less money.
Yeah.
So the higher tax bracket you're in, you obviously want to save on those taxes when you're earning high income. And then if you're planning on withdrawing from your RRSP in retirement, you're probably not going to be in that high tax bracket anymore. We're assuming, right? So save at high tax rates or save at high marginal rate and then withdraw it in retirement at a lower rate. And then just net save on the taxes.
Let's talk about health insurance.
Okay.
Since we're talking about this theoretical man dying.
Yeah.
Tell me about it. I've never thought about it before.
Okay. So like health insurance or life insurance?
Sorry, life insurance.
Life
but
insurance.
I guess both. We'll talk about all of it, but life insurance, yeah.
Okay. So life insurance. Where do we want to start? I like to lump them into a couple different categories because we got I like to mix up the terms. One of the terms doesn't really exist.
Okay.
There's like life insurance and death insurance.
Okay.
Okay. So now we can kind of compare what the two mean. And then there's this other category called like living benefit. All right. So traditionally life insurance, you think of like, if I pass away, my family gets money. Okay. Then you have living benefit. Well, if I get sick, I get money. Right. And this is an important topic because of the conversation we were having earlier. I forget who came up with this statistic. I think it might be like the Canadian Cancer Society. But 2 out of 3 people will develop cancer in their lifetime. 2 out of 3
terrible.
people. And I believe that the number following that is 25% of them are going to pass away. There's a high likelihood that someone's going to get cancer.
Mm-hmm.
And what's the average age that somebody gets cancer? It's 47.
Oh, wow.
So they're making money, right? They're probably maybe not in their peak years, but they're making good money, right?
Yeah.
If they're in like a traditional career. So what happens, right? If you are 47 years old, you get cancer and you're off work for a year. Do the mortgage payments stop? Probably not.
No.
Credit cards, car payments, food, bills are still rolling in, but you're not working most likely, right? You're taking 6 months off, taking a year off. So when you're in the highest income earning years, you're making $0. So in order to pay those bills, what are you doing? You're pulling from your retirement that you've been working the last 27 years to build. So there's this thing called critical illness where critical illness insurance, it was actually created by a doctor where the doctor was noticing that his patients who were getting these critical illnesses were financially struggling, essentially. Well, there's more to the story than that, but they were financially struggling. So they came out with this product that if you get sick, critically ill, cancer, heart attack, stroke, coronary artery bypass surgery, like big ones. I think there's like 25, depending on the insurance company you're looking at. But you get a one-time tax-free lump sum payout. Why? Well, it's to help you pay for your bills so that you're not stressed, for starters. And the money is meant to also give you a bit of a hastier recovery. Like maybe you got to go get special treatment. We've got, free healthcare in Canada.
Yeah.
But cancer meds aren't free.
Yeah.
Travel's not free, right? It adds up. I actually posted a story on my Instagram about, this was actually from the Canadian Cancer Society, about the costs associated with getting cancer.
We'll link it down below.
Yeah. Okay. So that's critical illness. Now, life insurance. There's lots of different types of life insurance. I like talking more so about the permanent stuff, right? Because you hear a lot of things on social media. Sometimes it comes from different, like the incorrect sources, people who are just talking about something. They're not licensed to talk about it. But have you ever heard of like becoming your own bank? Ever heard of that concept?
No.
Okay. Permanent insurance has a certain aspect to it where you can actually you can grow cash value inside of your insurance policy, right? Still acts like a life insurance policy, traditional, in terms of if I pass away, family gets it. But that only benefits the family if you pass away. So permanent insurance policies allow you to build up a cash value inside of that so that, one, if you don't plan on passing away, which I hope nobody plans on passing away early, make it to 65, you have a nice little nest egg that you can retire or utilize to supplement your retirement. Now, let's say, there's different ways that you can utilize this vehicle. You got universal life, you got whole life. If you have a cash value inside of a whole life policy, right, versus cash value inside of your TFSA, here's the cool part. So let's say you got $50,000 in your tax-free savings account and $50,000 of accessible cash value inside of your insurance policy. If you pull 50 grand out of your tax-free savings account to say buy an asset, buy a house, like a secondary rental property, well, what happens to your TFSA?
Oh, you're asking.
Yeah, I'm asking you. You had 50 grand in there.
Yeah.
You pull 50 grand out.
Yeah,
There's nothing in there anymore.
In there, yeah.
With an insurance policy, if you have 50 grand of accessible cash value in there, instead of withdrawing it, you can actually borrow against it. So now you're not touching the principal value inside of your insurance policy, but you're utilizing the cash value that you're lending against. So now you have your cake and you're eating it too, and you're using it to further your goals in retirement.
So how would that work? Is there a limit to when you can pull it out, and what kind of interest rate are you dealing with?
So, there's a couple ways that you could access that money. Let's say there's 3 ways. Pull it out like cash, right? Just like it would be for your TFSA. Do a policy loan directly through the insurance company, or you could do a collateralized bank loan, which you're using your insurance policy as collateral. There are limits, right? Depending on the insurance policy, it could come from, you could borrow 60% of your total cash value up to 90%. So I guess from 0 up to 90, depending on the way that it's structured. Interest rates vary. Again, policy loan versus collateralized bank loan. But the ones that I've been looking at in Canada, you're looking at about 6% interest rate. Okay. Now, if you use a collateralized bank loan, that depends on the bank. It's a little bit lower. Now, there's also a little bit more qualifying that you need to do for that. What else?
So what if you're like 65, 70 or whatever, and can you just close it out and take an amount?
You could technically. If you just wanted to wrap up some loose ends, sure. I think there could be said that is maybe the proper route to go in some small cases, but I do think the best way to go would be even still to just borrow money out of it. Because especially when a life insurance policy is a bit more matured like that, you have to think about it from the lender, like who's going to be lending you the money point of view too. So what do banks like? Like if you're going to go the collateralized bank loan, what are 2 things that banks love? Well, they love guarantees, and they love tax-free money. And if you didn't know this already, tax-free money or life insurance policies pay out tax-free. So if you borrowed, let's say, hey, Mr. Banker, I have $500,000 inside my insurance policy. I want to utilize this $500,000 as collateral to borrow $200,000 from you. If I pass away, well, banks love it because they know if I pass away, I'm 65 years old. If I pass away, well, they're going to get their money because even though I got $500,000 in my insurance policy, my death benefit's $2 million. So banks can get paid. I just assign them over as like a partial beneficiary. Mm-hmm. And not only are they going to get paid, they're going to get paid tax-free. Meanwhile, I'm borrowing $200,000 from them, but the $200,000 inside my policy is not coming out. It's staying in there.
What happens with the debt from a life insurance plan? Like if someone isn't paying it back, how does that work?
So we're kind of getting into it now because there's math and there's potential tax implications if you don't pay back the interest that you're owing on it. My thought on this is that insurance or the CRA is now looking at it like you're treating it as income, right? So let's say if you don't pay the debt back, the debt's going to accumulate, right? Sometimes that makes sense. We call that capitalizing your debt. Mm-hmm. Right? You don't pay your debt back until you pass away. And that makes sense in terms of maybe utilizing a policy as a collateralized bank loan to help with your retirement. I guess it's situation to situation. If you are, let's say, 30 years old and you've had your parents set you up with an insurance policy and you want to borrow money out of your policy to buy a house, I would suggest paying back the interest and the debt back, right? There's a good book out there, Be Your Own Banker, that talks about this, and there's benefits to paying back the interest and principal that you borrowed out of your policy, because by the time you pay it back, your policy is actually bigger, and then you get to utilize the strategy all over again. So if you get really efficient at this, and you start out with a decent size cash value inside of your policy, you could be potentially buying a new investment property like clockwork.
Mm-hmm. What would be a good age to start with it? I know a lot of people, if you're healthy, it's not something that's on your radar.
Right. Actually, on that note, the time that people really want life insurance is probably the time that they can't get it.
Right. I see. I actually have ads lately telling me at what ages the cost is for it, and
Yeah.
I don't really pay attention to them. So,
No,
but
that's fair. You said something with your phone on the table, and now it knows you're interested in it.
yeah.
Yeah. What was the question?
When people should start thinking about looking into life insurance.
I think the earlier the better.
And also, we talked yesterday about some people have it included with their work plans.
Yeah.
But maybe it's not full enough coverage or whatever.
Well, yeah, most insurance policies or work insurance plans do not have enough coverage because it helps the family, sure. But when you have life insurance, when you go get life insurance, I think the number one goal with this life insurance policy is to not give them a big check, like not give your family a massive check that they can go and like party and celebrate with. It's to take care of all the crap, like the mortgage, the debt, put the kids through school, right? And what's the average mortgage in Calgary?
I don't know. 500,000.
500,000. The average work policy takes care of between, I would say, 1 to 2 years of your income. I mean, unless you're making $500,000 a year or $250,000 a year, and you have a fresh mortgage, like it's not even a work insurance policy isn't even going to cover your remaining mortgage.
Yeah.
So,
and people maybe who are left with the money don't know how to handle the money too.
Yeah.
So
the lottery ticket scenario, you know.
I want to take a quick break.
Sure.
Do you mind?
Yeah, let's hang out with the dogs here.
We're on a break.
Whatever deals they got going on, because I know I'm going to end up on one of those lists.
Yeah, I don't give them my number anymore. Yeah. I've learned. Do you want to go back to the show?
Sure.
What's next? What's the next topic? Investing. Did you want to talk more about insurance?
No, I just think that people should have it. People should have it. People should know how to use it.
Save it for the podcast.
Okay.
Okay. And we're back.
Okay. And we're back.
So, insurance.
Okay.
Are we moving on from that? You had a couple more things to say about that?
Closing notes on insurance. People should have it, and people should know how to utilize it properly. And the way to utilize a property is to learn about them. Right? Not enough people know about insurance products, so do that. Go learn about it. Get some. It doesn't have to be a ton. Just get some, because you never know when you won't be able to get one anymore. Right? You know what? We don't have a crystal ball.
What stops you from getting one? You age out or sickness, that kind of thing?
Yeah, you can get sick.
What if you just smoke?
Your rates go up, but you're typically okay.
Okay.
Your rate might double, right, for the insurance cost. So you can if you get denied, so a good insurance company is going to underwrite you before, like when you go to apply. So stuff like mortgage insurance, they underwrite you. A lot of it's post underwritten when you go to make a claim. So they do, post claim underwriting, which means they're going to underwrite you, check if you're healthy after you decide to make a claim or your family makes a claim. So a lot of people don't get qualified for that. But if you get an actual insurance policy, something owned by you, you can get underwritten done before you actually get approved, assuming you get all the answers. Like you answered them all truthfully, you can get an insurance policy, and Now, if you get sick when you have an insurance policy, you're good, right? It's in your name. You got insurance for however long it says. Right? If you pass away, they can't fight that. Like they can't say, "Oh, you didn't qualify."
What if you have multiple? Like I have, let's say, one through work and then one through my mortgage. Are they conflicting? Do they help each other out? Is there any benefit to that?
It's good. They're good supplements. I would say still go get your own personal one, because the way mortgage insurance works is you don't own that policy. The lender does.
Mm-hmm.
And what happens if you pass away? Well, the lender gets paid, and then they give the family the house, right? But if you got a mortgage insurance policy for $500,000 and you owe $300,000 on your house, well, the lender gets $500,000 and they give you the $300,000 house. They don't give you the additional $200,000.
Yeah.
So get your own. It probably costs less, like, per dollar of insurance. And it's owned by you. You get to choose beneficiaries. Like, you get full control of it. So that's I guess another side note for mortgages.
Okay. Let's talk about investing.
Okay.
Let's say someone wanted to invest for the first time.
Okay.
What would you tell them to do?
Start.
Start. Yeah. But so it's confusing for people because you get ads for all these apps that you can invest with. You can invest through your bank. You can do it yourself. You can let them do it for a fee.
Mm-hmm.
It can be intimidating.
Yep.
Yeah.
Okay. Well, I think those apps are good. Like, stuff like Quest Trade, Wealth Simple. They're good apps to like get somebody going, but it doesn't. You don't necessarily get a ton of instructions on like what's the best thing for me to do.
Yeah.
Like, for example, some people are invested in high risk and they shouldn't be. And they don't necessarily know why. It's just the form that told them so.
Yeah.
Like that little KYC you fill out.
Yeah.
Okay.
So would you suggest people don't start like self-directed? Or
I would say if you're going to start, you should probably, like, if you just want to chuck money away, sure, you could do self-directed. But if you want to learn why and how much you should chuck away, or how much you should chuck away and why that amount, then you should go talk to a professional about it, and not somebody at the bank. I like the banks. The banks, I think, are useful for lending. I don't think they're that great. In my experience, they are not. It's like going to your accountant for like style advice on buying your house. They might have done it before, but that's not their thing.
Yeah. Do they just have a list of what to recommend?
Like the advisors?
Yeah.
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 I'm pretty sure.
I don't know. I did a little bit of that. I do self-directed because I'm interested, but it's hard to keep up with and a lot of people don't care. They don't want to read up on the businesses
no, it takes away from what's important. It takes away from the fact that like if you try to learn too much about it and you're not really interested, like you're not there to learn, you're there to learn because you want to know what to do, but you don't really care. Your effort is almost divided, and it would take away from the fact that you should actually be investing, right?
Yeah.
And then you're like, well, what do I invest in? And then it gets overcomplicated, and once it gets too complicated, it loses interest, and that's why having an advisor is so important. But yeah, banks have lists. I don't know if it is a physical list, but I know if I sit down with somebody from one of the big 5 banks, and they've had their advisor, in air quotes, because it's not the same person.
Yeah.
Right? It's just they're their figurative advisor in the bank.
Yeah.
I could probably guess exactly what fund they're in,
Yeah.
depending on the bank. Like, and I'm either dead on or I'm missing an additional word that they put in because a lot of the funds are just like derivatives of each other.
Mm-hmm.
So it's funny because we joke about it when we train our agents. We use them as like little examples because every single time we sit down with somebody with one of those banks, it's the same fund, or maybe there's growth in there,
Mm-hmm.
right?
Yeah. What about? So, what would be the first way to get investing? Like, if you don't want people to go to their bank and ask, Wealth Simple's fine, right? It's
Yeah, just
for small amounts. You can buy fractional shares.
Yep. Yeah, I think Wealth Simple is a good place to start if you don't have an
Or
advisor.
Quest Trade or whichever.
Yeah, Quest Trade's I feel like Quest Trade's a little bit more advanced.
Okay. Wealth Simple, you don't pay fees on Canadian trades, so that's a bonus.
Yeah.
You don't have to pay the. They make money, I think, from the conversion to American dollars a lot of the time.
So, okay. I mean, Wealth Simple, it says it in there. It makes it simple, right? So that's good. Good place to start that. But I feel if they are finding that they're not saving enough or their discipline is not there, then you should add another factor, which is where you find an advisor.
Mm-hmm.
Okay, so start there. But I think there's an important thing that you'd want to know about, because if you're going in fresh and you're like, I want to save money and I want to be a millionaire by this age. Okay, well, there's a certain thing that you should figure out. And there's a concept called the Rule 72. Okay? And the Rule 72 it was invented by a mathematician. Okay, I'll give you a little quick backstory. I don't remember the years. Old mathematician named Luca Pacioli. It was the mathematical equation that calculated how long it would take for a number to double. Right? It's the rule of compounding interest. And if you take the number 72 and you take your interest rate that you're getting, 6, 7, 8, 9%, how many times does that number go into 72? Okay. So if you have, let's say, a GIC with the bank, right? You're familiar with what a GIC is?
Mm-hmm.
Yeah.
But not everyone will be. So
okay. Well, guaranteed investment certificate, it's typically it's good because it's guaranteed. The downside to a GIC is that you're guaranteed only about 1 to 2%, depending on the year, depending on whatever the bank sets. Mm-hmm. So, hey, guaranteed. Oh, wow, 1 to 2%. Well, how many times does the number 1 go into 72? 72. So if you've got 10 grand, let's say, sitting in a GIC at 1%, and you are 20 years old, that 10 grand will double by the time you reach age 92.
Yeah.
Whoa. Okay. Yeah. So if it's 2%, well, then in that same time frame, it's going to double twice, right? 36 years and 36 years. So now it's, 40 grand is better than 20 grand, just better than 10 grand, right? But if you're looking at something that's maybe you're younger and you have a higher risk tolerance, how many times I don't know, I'm not that great at math anymore, but let's say
I threw my calculator somewhere in this room, so it's not handy.
Well, let's just go 10%.
Yeah.
10% roughly goes into 72 7 times.
Mm-hmm.
So that means your money's going to double 7 times. Starts at 10, so 20, 40, 80, 160, 320, 640, 1.2. What do we change? We change the rate of our risk.
Yeah.
From 1 to 2 to 10. So it's a big difference. And that's with lump sum, right? Not everybody's going to have 10 grand to wait 72 years or 7 doubling periods on. But then it goes to like the original conversation. Well, how much money do I need to save to get to this number? So regardless, we're starting from zero at some point.
Yeah.
Right. It might take us the first 20 years to save up 10 grand. Right. But then all of a sudden it takes us 7 years to double that 10 grand to 20.
Yeah.
So then if you're going to start saving, I would say if you're young, invest medium risk. Invest what you can consistently. And one, you could do the math and figure out, just calculators all over the freaking internet, like to figure out if I do this for this amount of time, how much money am I going to have? If you like that number, just stick with it forever, right?
Yeah.
And make it a priority.
I bet a lot of people are just Googling like how to short Tesla or how to buy Tesla like right now.
Everybody's looking for the shortcut.
Yeah.
Everybody's looking for like the way, like the secret method. But the most renowned investor, I think, still to this day is Warren Buffett.
Yeah. I love to follow him. I feel like a lot of younger people now also, their perception of stocks is going to be so thrown off from crypto because they just made 100 times their money with like a coin flip instead of the 10, like 12% would be a really good year, right?
Yeah.
So do you think people might start investing less?
Like less than they already
in stocks.
In stocks? Well,
like maybe 5 years from now compared to 5 years ago.
I think the people that are saving money are going to keep saving money. I think the new era, like the new generation of people coming in that want to invest, they might be more inclined to take the shortcut path because of social media, because
like
of
the
like
TikTok era.
Yeah.
Faster gratification on things.
But like at the end of the day, I think people need to understand that, hey, you know what? A 50% year, like maybe your Bitcoin grew by 50% in a single year or whatever it is, like kind of like a major coin at least. Yeah, it grew by 50%, but if it drops by 20% the next year, like you have to keep in mind this. So I actually have a good analogy for this. If you have 100 grand and you started at 100 grand, you invested poorly and it dropped down to 50 grand. How much did you lose in terms of a percent? You lost 50%.
Yeah.
Okay. But if the next year you wanted to get a return that would bring you back up to 100, what do you have to get as a return?
100%.
100%.
Yeah, a lot harder at that point.
You have to work twice as hard to repair the downside loss that you just did. That's twice as important to protect yourself from the downside of the market. So yeah, crypto's great. Crypto's also risky in a lot of cases. So is like buying solo stocks, right? No matter how promising the company looks. I mean, you're my age, so you know, I mean, back in like 99, people were very much, focused on Nortel. And it was like 2000. People that were making $1 million in their parents' basements were no longer making $1 million.
Yeah. I try to diversify. I have like 2 in each sector. I'm even thinking about buying some physical gold.
Yeah.
Why not?
Yeah. Hey, it's a commodity. It's a good.
I don't know why I would do that though. Or I could buy Canadian Mint stock, but then I don't have the gold, so I don't know.
I think you just want to look at gold's always. I feel like gold's always gone up over time, no matter the market.
Yeah,
it's like if the Canadian dollar goes down, gold's not going down. Gold's not determined by how much tariffs are in Canada or like how China's oil economy is going.
How have the tariffs affected you in business? Has it come up much recently?
I've had questions, but it hasn't really affected me.
I guess they're not even around. They're not active right now anyway.
I've had, I've got a couple paranoid clients.
Yeah, I've heard a lot of paranoia from people.
Yeah, they're thinking, um, I they might be thinking a little bit short term. But I get asked more so about not how everything's going with the tariffs. It's how is this going to affect my money? I think is a valid question, but I think it would need to actually be enforced. And unless we're investing in specific stocks,
Yeah, like specific industry could
like
beat it. Some might do better because of it, but
if 100% of your portfolio is in Canadian automakers,
yeah,
like you might be in for a ride. I don't know. I don't know
Yeah.
which industries are going to be affected the most. But yeah, I feel like oil, like any of our like primary exports to the US. Yeah.
there's always stuff going on. Like took a huge hit that morning. DeepSeek news came out, so all of I have too many tech stocks, but I dropped so much. The next day, everything was back to normal.
Yeah.
So
You have to keep in mind that like if you're investing properly, you're investing for a strategy that exists longer than a year from now. So when COVID first happened, my phone was blowing up. People were freaking out.
yeah,
The market dropped like 30% over like a day.
yeah,
And then what do people do? When people see that happening, what do? They pull out.
yeah. That's
Right.
too bad.
If they waited, I don't think I had anybody actually fall through with it. I think I talked most of them off the ledge.
Yeah,
If they stayed in by the end of the month, because this was like the beginning of March, like first week of March, 2020, market went like, pew. And then the end of March, it was like 80% of how much it was at the beginning of March. So like it's coming back. And then people that stayed in, they think they were up like 40% by the end of the year.
yeah. It's too bad that, like looking back, I wish I had a bunch of cash to buy at that time. I did buy a bunch of stocks that I thought were going to have a huge rebound, like Air Canada and the people who own WestJet
I bought Air Canada too.
and Cineplex too. Like all the things that I thought dropped excessively, they didn't really come back. Everything else did, but yeah.
I try not like my investment strategy is pretty like because I'm an advisor. I think people think that my strategy is so like it must be so much more technical than mine. But
I would assume if I guessed that it would be actually on the overly safe side, if anything.
not for me.
Yeah.
I I actually invest pretty aggressively. One, because I know I have time.
Yeah.
And I know I have cash that if I see that the market does drop, I could pull cash to invest back into the market.
Yeah.
So it's the same stuff that I tell my clients to do. I'm just a little bit more risky
Yeah.
in the sense like I'm very tech.
People think you're like keeping secrets from them.
Yeah. They like, I want what you do. I'm like,
Yeah.
are you sure? Because you're like, I see the roller coaster of the NASDAQ. I'm really heavily into NASDAQ. I actually only invest into 2 investment funds, the NASDAQ and one that really closely follows the NASDAQ, but it has a little bit extra in there. And one, it's not that I'm like very, very tech focused. Like I don't follow all these companies, but I just know that there's a lot of diversification in there.
Yeah.
And I don't think tech is gonna, if it does take a hit, it's not gonna take a hit for long. And yeah, it's about being able to not get emotional with your money when the market's going to drop.
Yeah.
The market's going to drop. And if you're okay with taking a temporary 30% drop and know that it's going to come back and then some, then you're okay.
Mm-hmm.
But if that freaks you out, then you don't want to invest like me.
But you're right, though. Tech kind of encompasses so much more than it did like when the .com bubble was happening.
Yeah.
So now, even when NVIDIA lost like 600 billion the other day or whatever, my ETF, I think it's QQQ, that one, it went down like 2% or something. It wasn't really affected because of everything's tech. Like,
Yeah, big invest, like, well, the NASDAQ's the top 100 tech companies.
mhm.
Right, NASDAQ 100.
That could be biotech, an app. It could be, Uber. There's everything is tech related now, so it's hard to.
Like NVIDIA's, I think, probably one of the top 3 holdings
Mhm.
at like 5%.
Yeah,
So if NVIDIA drops 20%,
Yeah.
the whole fund isn't going to take a hit.
yeah. And if the whole fund drops 20%, then like the world is in chaos at that point.
Mm-hmm.
Yeah.
Yeah. Yeah, you got more problems to worry about than your money. You probably have zombies in your backyard.
Yeah, exactly. What else? I mean, we've had a long show so far. Do you listen to any finance podcasts?
I used to. To be honest, a lot of them are kind of dry.
Yeah.
I found a lot of them were kind of dry, and I don't think I was gaining enough from them anymore, because that's the only reason why I listen to podcasts is if I'm going to pull something out of it,
Mhm.
right? Something that I can employ in Canada. Because I also work in the U.S.
Yeah.
So I got to be careful, like which information I'm gaining.
Mhm.
Sometimes you can't cross over.
There's a Wealth Simple has a podcast,
Do they?
TLDR podcast. It's called.
Oh, I get their email.
I like their email actually.
It's nice,
pretty
and
good. It's
yeah.
2-minute read, and the way they put it into perspective, I actually share it. That's one of the only newsletters that I actually like.
That's like, I like their graph.
Yeah,
Like
me too.
Important and interesting, I think, is like
Yeah,
their
and
summary
like
of it.
Crash and burn to the moon.
Yeah.
Like it's fun. It's like really digestible for people, I think.
Yeah.
It's not too heavy.
It's a nice easy entry, I think.
Mhm.
Like
That's
I
what their
like-
podcast is like too. It's 20 minutes.
Okay.
Kind of just covers the news. Sorry about that.
That's good.
It's yeah. There's a couple I listen to though.
The only so well, I want to go back to like
Mm-hmm.
when we were talking about a new investor, like a newer person who's thinking about getting into investing, is there's commercials out there when they like to, what's the word? Their ammo that some of these like self-directed companies will use. The ammo that they use is fees.
Yeah.
Okay.
I'm gonna take a picture of this. This is hilarious. Not allowed. Okay, sorry. Go ahead.
Questrade, a lot of times you'll see these commercials, but the ammo that they use is fees.
Mm-hmm.
And as much as like, yeah, fees are important because it comes off of your normal rate of return.
Yeah.
Okay. But I would don't get caught up in what a fee is to prevent you from investing the right way.
Mm-hmm.
In Canada, any MER, which is a management expense ratio, that is the fee that I'm talking about when it comes to investing. Any MER is already taken off before you see a rate of return for an investment in Canada. So what would you rather have? In Canada, so what I just said, if you had 15% rate of return on a fund, pretty decently performing fund, but a 5% fee,
Mm-hmm.
which means your fund got 20. They took off 5, you got 15. Okay. Or would you rather have a 10% fund with a 1% fee? So it did 11, got 10. You want a 5% fee or a 1% fee?
Yeah. Well, so I like RBC. I pay $10 a trade, and it really bothers me. It makes me want to never do anything.
I think trading's different because that's stocks, right?
But so with the ETF, I've never really looked into the MER. I don't know what that even means. I mean, now I do because you told me.
For most ETFs, the MER is minimal because it's like a fraction of a percentage. But if you take a look at like,
what about buying American versus Canadian stocks, and the conversion? Is it better to get American money, go buy the stock, or?
I do not know the answer to that.
Someone does.
Someone might.
Go on.
To be honest, I don't know if it would make a terrible difference. Like, I feel like if you have a U.S. stock and a Canadian stock or a U.S. fund and Canadian fund or ETF of the same ETF, the conversion's done there. But if you go and get U.S. dollars, you do the conversion there. So you're just kind of converting it back and forth.
Sometimes buy hedged, like CDR through CIBC hedged stocks. Like I have Costco. It's like $30, let's say, for a share of the hedged Costco stock. Or I could spend $900 and buy one share of Costco through the American market.
It's like a fraction of a stock that you're comparing to.
Yeah, I guess. Well, when these CDRs that I bought came out, I couldn't buy fractions of stocks, and now everyone can do that. So I don't know.
That was that's an investment fund that has always been like that, from what I understand. You always buy fractions.
Yeah.
Right.
I wonder if how it's affecting the market, having everyone be able to buy fractions of shares and buying and selling such a low amount at all times for things.
I think it's fine. Well, I don't know about stocks might be. I mean, what they'll do is they're going to pool all the people that bought fractions together and then buy full ones, right? That's the same way that investment funds work. You know, you go through a company like Fidelity, the big investment company, but you can buy fractions of a unit of like Fidelity Canadian Opportunities Fund. Okay, you can buy a quarter unit, let's say. But there's going to be 1,000 to 100,000 people also buying different variations and sizes of units. So inside of this fund, you have 100 companies or 250 companies. And with this now $2 billion or $100 billion or whatever the amount of money that they pull together, they just buy the percentage of these companies in terms of stocks.
Yeah.
Right? Because it's such a big pool of money. That's how that will work out for them.
What's your favorite way to invest? Is it ETFs?
Investment funds, like segregated funds right now.
Okay.
Yeah. Which is this, I mean, the NASDAQ is an index fund. So I like to have the variety inside of the fund. It helps with a lot of the stability. It prevents the Nortel effect.
Yeah.
Right. And it honestly, advisors are the same way. Like, we don't want to spend all of our time trying to figure out which investment strategy to use. We want it to be just as simple as everybody else.
Yeah.
Right. I would say we see it from maybe a little bit of a different perspective because we're also watching people make choices.
Yeah.
But yeah, ETFs, index funds. I have investment funds that are not index funds, so they're created by a company. And I guess my favorite way to do it is consistently. That's the number one thing consistently.
Yeah. Just routine.
Yeah.
Um,
Just take the thought out of it. I think taking the thought out of it would help out a lot of people.
how can people reach you?
Instagram.
I'll put everything underneath the video. I'll tag you and everything,
Sweet.
but say it anyways.
My Instagram is Mitch Pag.
Yeah.
At Mitch Pag. That's the short version of my last name, or Pug, as the Filipinos will correct me on.
That's why I had you introduce yourself, because I didn't want to get that wrong.
Yeah, that's okay. A lot of people get it wrong the first time. I've got all sorts of nicknames, so I just go with Mitch Pag. So a lot of people will recognize that name.
Yeah.
Because I live in Airdrie. They know my mom is Mama Pag.
Oh, nice.
Yeah.
Is there anything else you want to say before we go?
Thanks for having me on.
Thanks for coming.
Yeah, I haven't watched that wall, but I've seen this wall, and I think you showed me a picture of the wall when you first got it set up, like
Yeah.
the landscape, and I was like,
You know what? I kind of ruined it.
why?
I didn't mean to. I don't know if you can see the cloudiness, but now everyone's going to see it. There was too much of a reflection, so I sprayed it with a clear coat. I don't know, some kind of matte coat, but I was too close to it. And
Oh,
there's, like splotchy areas.
I see a little bit of
I
it.
wish I never did that, but it's hard, and it was so reflective, and the lights are giant and bright, so there's like no way around it in this kind of room. It still looks pretty good. I love it.
Mm-hmm. It looks really nice.
Thanks.
Did you do it?
Artificial intelligence did it. Yeah.
How?
On Mid-Journey, I asked. It was really hard to get to imagine the bow tower. I was writing like Ukrainian egg-shaped building, but I just for like 8 hours I kept changing the prompts, and then I got this picture, and then I sent it to a wallpaper company.
Oh,
It's 8 panels of peel and stick wallpaper.
cool.
Yeah, AI. Hey,
AI.
it's
I
going
need-
somewhere.
I need my landscape to look more Canadian. More Canadian.
It turned out pretty well.
That looks really cool, man.
Yeah.
Is it the actual landscape? Like I see familiar buildings, but
No, it was trial and error to make the buildings I wanted.
because if that was, the mountains are on the wrong side. I was just thinking about this.
Yeah, don't tell anyone.
Okay.
Yeah, and I wanted Brookfield Place.
Yeah.
Kind of. I did my best. I wish I had. My favorite buildings are Bankers Hall. I wish I could have put Bankers Hall in there.
Just paint. Take a
Yeah,
little
maybe I'll get a
paintbrush.
painter. But people get upset when you use AI. They're
Mhm.
like, you're taking from the artist, but this wasn't made by an artist. This is randomly generated. Maybe it's from hundreds of artists, but
Or computer programmers or artists.
there was no time. Nobody is hurt by this.
No.
Everyone's happy.
You took a potential job from an ACAD student.
That's true, but it was they couldn't do it for that price. Before we go, AI in trading.
Oh,
What do you think of that? Is it sustainable even? Are humans even involved at the end in the end game of this, or is it just machines buying and selling at all times? On a closing note.
hey, let's drop a bomb right at the end here. Well, I don't know enough.
Is your job safe?
Yeah.
Okay.
I'm not a trader.
No, but is your job safe?
Yeah. My job's a people job.
Yeah.
My job's taking complicated subjects and making them simple
Mm.
so that you'll remember them and you don't have to take a 4-year-long personal finance degree.
Right.
So if I could do that, my job's safe. If all I am is a transactional guy to help you withdraw and deposit stuff into your tax-free savings account, yeah, I might be at risk.
What if people go to ChatGPT and write, whatever, this is what I have? Yeah, I think those people would have already, they don't need you at that point, actually. And it probably wouldn't be accurate.
I think, who knows? Maybe ChatGPT 6.0 is going to come out and all of a sudden nobody needs to work anymore, right?
Yeah, that's true. Also, another question I forgot to ask, even though we've wrapped.
Yeah.
I heard that the life insurance companies know way more accurately when people are going to die compared to doctors.
You hear this on Joe Rogan?
No. Actually, I probably heard it from Gary Brecka, which is like Joe Rogan by association.
I think I heard this on a Joe Rogan, Gary Brecka
Yeah.
podcast.
He has his own podcast. So, and he did a tour.
Did he?
Is that real?
I think so, especially in the U.S.
Is that just because I don't know, is that a byproduct of how the whole system works, like the economy? Like there's more money in life insurance than, well, I guess with doctors in the States it's different, but
Well, that's kind of what all insurance companies, I don't know if it's the same in Canada, and I don't even know if they share the same data. But how could you have a company and your business model is essentially predicting when people are going to pass away?
yeah.
The better you are at predicting that, the cheaper your premiums could be, or the more expensive you have to charge.
Yeah.
So, I mean, if there is like the golden ticket to tell, like what was that movie called with Justin Timberlake where you have like a
In time.
like you knew exactly when you were going to kick the can,
Yeah.
right? Insurance companies wouldn't exist,
Right.
But
Well, they
unless
might
they
know.
were the only ones that knew.
So I feel like they have a moral obligation to tell everyone.
Well, they don't know.
Could
they
be
can
wrong.
calculate it.
Yeah.
Like, for example, if your ancestry comes from two different, like a certain part of the world, you might have a longer lifespan.
Yeah, or
Okay.
a predisposition to a certain deadly illness or whatever. Yeah.
Yeah. And there's enough people that have probably in your shoes, came from the same place, had similarities, and they could derive the right information to a pretty good guess.
Yeah.
Right? I mean, in Canada or in North America, the average age for a male to live is 85. That's a pretty good estimate. 87 for females.
Okay. So why wouldn't doctors get access to this or apply this for their practices
Well, I think,
in the States? In Canada, it's just whatever.
well, I don't know if the doctors have maybe they have the data. Like maybe they have access to the same information. But it's like taking a look at code,
Yeah.
right? You need code readers, and you need people that are, I forget their role in the insurance company, but there's like people that are like, that's their stuff. Like that's they're the Rain Mans of the insurance company. They calculate all these things and they can make pretty good assumptions. And if the doctors might have that information, they might not know what to do with it.
Yeah. And they would probably, if they're wrong, if your doctor's wrong, they're probably more likely to get sued over something.
True.
Yeah.
I mean, have you ever felt sick? You gone to the doctor and they tell you you're fine?
Yeah.
Yeah. But that doesn't make you feel better.
No.
No. You're like, that's great. I'm glad my blood work came back fine. I
Yeah.
feel like trash.
Yeah.
What do I do next? Drink water.
Yeah.
And I mean,
Should
there's a
drink
lot
water.
I feel like there's a lot of guys our age that are kind of going through that too.
Yeah.
They're like, they don't really feel high energy anymore. I mean, I'm speaking from my personal life is like, sometimes you gotta get energy dips. Maybe you wake up tired. You start to be like, man, maybe something's wrong.
Mm-hmm.
I'm not sick. Maybe
Yeah.
something's wrong. You go to the doctor. Everything's fine. Go get your hormones checked. Everything's fine. Go to naturopath. You need more vitamin D. Like, okay.
Yeah.
Doesn't.
Just like with finances, people don't worry about it when they're young till there's issues come up. So like, think about when we were working in bars and stuff and how little sleep we got and how horribly we ate.
we still
and-
bounce back.
Yeah. I could not do that now.
No.
But let's wrap.
All right, let's
We covered everything we possibly could.
to wrap up 2.0.
Yeah. Any
Okay.
last words now?
Second last words?
Second last word. Well, the ones before would have been the second last words. These would be the actual last words.
Okay. Well, I had fun. Today.
Me too.
And I would be like, I hope we get to do it again, but I feel like that would kind of ruin the aesthetic of the show.
We maybe could do it again.
Might have to
Next
wait
season.
a year.
Yeah.
Yeah.
Okay. You'll be back.
Cool.
Thanks for coming.
Thanks, man.
Whoa. I forgot those were red.